Hi everyone, welcome to our webinar on 401k Compliance Essentials. Before we dive into today's topic, I'm going to run you through some items to help you best leverage our platform. Your webinar dashboard is interactive and customizable. You can personalize your view by moving, resizing, or hiding different elements on the screen. Simply use the corners of the icon to adjust the size or position. You have many tools running across the top ribbon of your dashboard. If you can't find anything, look there first. We encourage you to engage with us using the interactive tools. If you have any questions throughout, please submit them into the questions box on the lower left corner of your dashboard or press the Ask a Question button on your top ribbon. We will do our best to address your questions in real time. You will also notice a survey on your dashboard. Please fill this out anytime during the presentation. To let us know your thoughts throughout the presentation, use the emojis at the bottom of your screen. Your survey and your emoji reactions are used to craft future webinars and are very valuable to us, so please use them. For those of you seeking CPE credit, you will need to answer 3 of 4 poll questions during the webinar. CPE certificates will be sent out via email within a couple of weeks. Lastly, this session is being recorded. You will receive a link to the recording within a couple of days. If you want a copy of the slide deck, you can download it from the left side of your screen at any time. You will also find links to other resources there. For those of you who aren't familiar with Richie May, we have served the financial services industry for over 40 years and have a team that specializes in employee benefit plan audits. We have a full suite of services and products designed to enable our clients' growth. Our experts believe in the forward progress and success of the industry and dedicate much of their time to teaching. Today, our presenters include one of our employee benefit plan audit experts and guests from Alvarez and Marsal. I'll turn it over to Katie to introduce our guests and dive into today's topic.
Hello, I'm Katie Compton, Assurance Partner at Richie May. I also lead our Colorado Division's Employee Benefit Plan Audit Practice. We're really excited to have both Michael Schmidt, Senior Director, and Patrick Blanchard, Managing Director, here from Alvarez and Marsal. Thank you both for being here today. And for those that don't know much about Alvarez and Marsal, could you maybe share some areas of expertise you have in the compensation and benefits areas?
Sure, thanks, Katie. My name is Patrick Blanchard. Like Katie said, I'm a managing director with Alvarez and Marsal. The firm as a whole is a global management consulting firm. We have about between 11,000 and 12,000 employees worldwide. Michael and I sit in the comp and ben practice. We're both attorneys by background, but because we are a consulting firm, we're not providing providing legal advice to our clients. What we do help with our clients with as a firm and as our practice specifically is when the dangers and corrections and failures come up with retirement plans, we're there to help get the plan back on track. The way I usually put it is that we're Lunesta for HR professionals regarding their 401k plan. If an HR professional is losing sleep over it, we're going to come in and help them get some sleep and get the plan back on track. So we help with different kinds of corrections, like I said, but we also help with representation in front of the IRS and the Department of Labor when those come up, whether it be through audit assistance during examinations, or if there's going to be a voluntary disclosure to either of the Department of Labor or the IRS, we can help there as well. Thanks, Katie.
All right, so I can jump in. As Patrick mentioned and Katie mentioned, I'm Michael Schmidt, a Senior Director with Alvarez and Marsal. And jumping into the kind of overview and the approach for this webinar, we want to cover compliance essentials. So what can go wrong, why does it matter, and how do you get it back on track? And you'll see a few bullets here. We'll call them learning objectives. The first is the why does it matter, the plan qualifications and the impacts of disqualification. So that's a very important piece of this. And then we'll walk through different types of errors that we see within plans, focusing mainly on the different types of contributions and how they can go wrong. We have plenty of horror stories to share there. We've seen it all. And then we have a brief overview of the IRS and DOL correction programs. And then what we want to do is make sure that everyone's leaving with some valuable takeaways. So how to restore plan compliance. And then, I mean, in the ideal world, we're avoiding any actual or mitigating any future contribution and remittance issues. And throughout, if there are any questions about any of these aspects, we're happy to jump in and address any questions as well.
So we have our first poll question. This is going to be one of 4. Have you ever encountered a missed or late 401k contribution in your organization? And the answers are A, yes, frequently, B, occasionally, C, rarely, or D, never. When we think about late contributions, we're thinking of, oh, I've have the remittals from the participant from payroll. Have I sent it over to the plan for those participant contributions to be deposited into their account? We are getting close. We're about 60% of the attendees have answered. Give it just one more minute. And we'll be going over the definitions of what missed versus a late contribution is too, because I think the distinction and how those are handled is very important. We're at 75%. Okay. We're going to go into the polling results now. So this group has either rarely or never had late or missed contributions, which is great to hear. As we get farther in, if you have questions about either of those topics, please feel free to ask. Throw it back to you, Michael.
Michael, you're on mute.
Thank you. Jumping back into the why of all of this, we want to make sure that we understand the benefits of plan qualification. I think most employers understand various aspects of this, but it leads into what the negative impacts of these compliance issues that we're going to delve into further down the road and how they could negatively impact the plan. And so starting with the advantages. So if we're just speaking and thinking about this in kind of the common parlance, that a lot of people understand what a 401k plan is. It's a qualified retirement plan. And that qualification offers several advantages. And the first piece that we have here is the no current income inclusion to participants for benefit accruals in the plan prior to the actual distribution. And so what that means is there is a deferral of income recognition. So we talk about throughout this presentation, we'll talk about 401k deferrals, and the deferral piece is the deferral of that income recognition, and it's being taken out of the employee's salary or income and deferred into the retirement plan here. And the additional pieces that we have here is that there are certain types of contributions that are recognized at the time that they are earned. And that would be an after-tax contribution, which is a specific type of plan contribution, or a Roth contribution, which is a little bit more familiar to certain individuals. But the Roth contribution is currently taxable, but then there is still there is no recognition of the gain, and it's not taxable at deferral. So initial benefit is this deferral of income inclusion. Other pieces of this are the plan assets. So all employees' contributions are being deposited and held in trust for their benefit until distribution. Normally, a trust generates income. That income is taxable. In the case of a qualified plan, that income generated, subject to some limitations, is free of taxation. So the income, the growth of that, the amounts held in trust is generally free of taxation. And then the other piece of this, we mentioned the employee side, there's a deferral of recognition of income. On the employer side, so maybe within our audience, what the focus would be, part of the reason why these are valuable to companies is there is a current deduction of the employer contributions, even though those would not be recognized by the employee at the time of contribution. And this is essentially breaking a pretty standard principle within taxation that normally there wouldn't be a deduction until the employee recognizes it. Here, because of this qualified plan, there is a unique scenario where the employer is able to deduct, employee is able to defer recognition. And then the other piece of this is if you have a qualified plan, there's an ability to roll. We mentioned roll over into an IRA if there's a separation from service, but obviously it could be broader than that. There could be an ability to roll into another qualified plan. So as employees move and change jobs, there's an ability to continue to have those assets, those contributions be qualified. So obviously beneficial tax aspects from both the employer and employee side. This is just looking at tax benefits of the qualified plan. Additionally, and this may go somewhat without saying, there's the benefit of potential employee attraction and retention. You oftentimes see companies need a retirement plan in order to be a competitive and attractive employer. Jumping into the conditions of a plan qualification, this is a summarized list because if we were to go into all of the qualification requirements, we would look at code section 401A, which lists out what the requirements are for plan qualification, and there's 30 plus provisions within 401A that detail the different qualification requirements. And honestly, some of those are referring out to other provisions as well. So it's a pretty comprehensive listing, and that's why compliance can be challenging. what we've highlighted here is some of the kind of higher level pieces of this, the written plan document requirement. This is something that we see, and some of this is the actual execution of this. So do you have a written plan document, and is it truly executed and effective? So I'm sure as part of audits, Katie's looking at and checking to make sure that plan documentation is appropriate and sufficient because of the potential impacts on qualification. Mentioned the overall kind of overarching aspects of 401A. And then the other piece of this is tying that written plan document to the operation. So 401A is going to set out a baseline for operation. So who do you have to make eligible for the plan? What are vesting requirements? And then the plan itself is going to have written terms within it. And those could be slightly more generous. And so you have to take that step of operating within in accordance with the written terms. And then specific demographic requirements. We don't drill down into the specifics of eligibility here, but what we are looking at is qualified plans. The reason that they are afforded tax beneficial treatment is they're intended to cover a broad cross-section of employees, and also not solely in favor of highly compensated employees. And so when we think about this, it would be possible for a company to set up a plan that benefits only certain individuals within the company in a discriminatory manner. And one of the underlying principles of plan qualification is that it does have to broadly benefit and then do so in a non-discriminatory fashion. With that, I'll turn it over to Patrick just to cover some of the high-level impacts of disqualification.
Thanks, Michael. So Michael just went through kind of what it means to be a plan. The consequence of disqualification partially keeps Michael and I in business. Because if a plan becomes disqualified, there are pretty draconian consequences of doing so. First of all, participants would be taxable on the contributions made by the employer. So whatever their accrued balance is, they'd get taxed. If the accrued balance is $20,000, employee is going to get taxed as ordinary income in the current year on $20,000. If their accrued balance is $1 million, it could be that they are taxed on the full $1 million. And that is a pretty bad result for participants, especially when you think about it in a plan of any size, even more than 10 or 20 people. There are going to be a lot of innocent bystanders that are caught up in that. So that makes that one, something that the IRS does not want to do. I would say that as we're talking through these things, the IRS kind of bends over backwards as long as there's not fraud or bad intent to disqualify a plan. They bend over backwards to retain qualification because of how bad the impacts would be on those employees. On the employees also who have made taken rollovers or tax-free rollovers, more specifically, those would be taxable also. So if I rolled over that $20,000 from my 401k plan into an IRA last year, I don't get taxed on it because it went into a tax-free IRA. If the plan ends up becoming disqualified for last year, updated reporting would have to be sent out to me, and I'd be taxed on that $20,000. Again, terrible result for innocent bystanders. So the IRS and DOL want to avoid it. On the other side of it, the plan's trust would lose its tax exempt status under Code Section 501A, and there'd be a resulting trust level tax on the trust earnings. So you have now a recognition of income on the employee side, and all of a sudden you're going to have taxes at the trust level as well. Finally, the employer would have lost its deduction for deferred contributions made to the plan that aren't vested. So they for those that are vested, it's back to that matching principle like Michael was talking about. Now that they're being recognized by the employee, the employer would get the deduction, but to the extent they're not vested, the employer would lose their deduction. So you really have a negative impact on kind of all three parties to the transaction here: employees, the trust to which all contributions are deposited, and the employer who's making the deposits to the trust when there is disqualification. So like I said, they bend over backwards to avoid this. In my career, we've never actually disqualified a plan or had a plan disqualified. We've seen plans have been disqualified previously, but again, that's because of bad intent. And I've had clients look at a disqualification, but at the end of the day, they were always able to come to some kind of agreement that was agreeable for both the IRS and the plan sponsor when that is the case. So the TLDR, too long didn't read version of that is plan disqualification is terrible to everybody and everybody gets taxed. And we want to do everything we can to avoid it, and the IRS does too. Thanks, Michael.
And just one additional piece to tack on to what Patrick said, IRS is going to make those efforts to kind of work with the plan sponsor. We do see disqualification as that like big stick that they have. If the IRS doesn't like something that has occurred, that's always the looming threat there. So we want to be proactive in the correction approaches and make sure that plans don't get into a position where IRS starts throwing it around, because you lose leverage pretty quickly, even if they're not likely to fully disqualify. So, all right. So jumping into actual failures that we see, and so if we kind of relate this back to qualification requirements. What we're looking at here in some aspects are the written plan document, and then also the operation in compliance with the specific Internal Revenue Code requirements as well. And we're going to start on the employee side of things. And the first one that we have that individual or that plan sponsors may see is a 402G limit failure. And I don't know, Katie and Patrick, we did have a question come in. We can certainly address that, Katie, from the perspective of an auditor, and Patrick and I can speak to that broadly as well.
Yeah, thank you. So the question is if you get your 401k audited every year, are they checking to ensure the plan is qualified? For the most part, all of the plans are qualified. I think the area where we find some deficiencies is that those plan documents may not be getting updated or amended timely. They may be missing parameters that they're supposed to be doing, especially with all the new guidance that's been out there and all the new regs that are coming through. Just making sure you get your plan updated. And as you get it updated, making sure that all the individuals that work within the plan at the plan sponsor are getting a copy of that so they know what changes have occurred. And those are more the deficiencies that we see, is not that they have anything that would disqualify their plan, but that to have a qualified plan, you are supposed to stay up to date on all of the regulations and updates.
Thanks, Katie. And just speaking to that broadly, the audit approach of kind of sampling participants to see the operations of the plan is, and Katie, keep me honest here, is to validate the accuracy of you're auditing the financial statements of the plan to ensure those are accurate and appropriate. So there's an aspect of qualification, but you're not fully, I guess, auditing the operations of the plan.
Correct. We don't audit 100%. We're always sampling. For the qualification, one of the areas we look at, and many of our clients and the people on the webinar today are in a prototype plan. So we're looking at the IRS qualification for that prototype and that they're following the prototype plan. We do have some individuals' plans that have their own IRS determination letter, but the qualification most of the time is coming through that IRS letter that you do have a qualified plan and that you're meeting all the parameters through those prototype plan documents.
Perfect. And I would definitely appreciate the question and would encourage more. I think the understanding of the purpose of audits and potential issues that could pop up is definitely something we want to make sure that everyone's comfortable with. So again, speaking to deferral failures, and when we're saying deferral, we're saying employee contribution failures. The first is the 402, which is a code section, the limit that is imposed there. And this is a cost of living adjusted limit each year. Currently for 2025, it's $23,500. And that's looking at any pre-tax contributions and any Roth contributions and the total of those. One of the things that can make this limit somewhat tricky is usually payroll systems are somewhat well equipped to cap this. Record keeping systems are going to look at this. This is an individual level limit. And so if someone is a new hire mid-year and has already deferred, that individual cannot contribute above this limit, even if he or she had previously contributed to a separate plan. So 23.5 across any contributions. And as an employer, and anyone on the line, you may wonder, well, how am I supposed to monitor past contributions to another plan? And the easy answer there is that generally speaking, you're not required to monitor contributions to an unrelated plan. There may be situations where an employee identifies it and reports it to you and asks that a certain amount be distributed. The other thing to be careful with here is if there's a group of related companies within a controlled group, that limit applies across the controlled group. So monitoring transfer populations, that would still be within the plan sponsor's purview, even though this is an individual limit. So it's the employee that is subject to this failure. So, but what we're looking at, I'm guessing Katie's seeing at times too, is to make sure that there's no contributions in excess of this from the employee. Next item that we have here is deferral rate failures. And this is something we've gotten to a point where most systems are communicating with one another. If we had a small group or in-person audience, I might poll the audience to see how deferral rate elections are flowing through systems. But generally speaking, employees are making an election with their TPA or record keeper. So thinking going into the Fidelities or Vanguards or T. Rowe's or Schwab, and making an election, and that will feed back to a payroll system that then deducts according to that rate. It sounds simple, it sounds perfect. We see quite a bit of a disconnect. Systems are built to talk to one another, but they don't always talk to one another. I don't know if it's in the same language or at the same time. And it's not uncommon to see the feeds, and it could be timing issues or just data challenges. And so if we think about this deferral rate failure, employee goes into record keeping system, elects to defer 6%, but for whatever reason, the prior election and payroll does not change to that new election, and the employee continues to defer 3%. So at that point, he or she is deferring less than what they've elected to defer, and could be missing out on matching contributions, and could be not receiving the full benefit of the plan. Final deferral failure that we have listed out here, we see these come in all different shapes, sizes. As I said, we've seen it all, but we see something new every day is maybe a way to think about this. Missed deferral opportunities. This is a situation where enrollment does not work appropriately. And these can, like I said, have a few different shapes and sizes. So if we're thinking about someone who's newly becoming eligible, and for whatever reason, the company doesn't identify that, or the record keeper doesn't feed the appropriate information, and this new employee doesn't have the opportunity to make deferrals to the plan. So she's missing out on, again, the deferrals that she would intend to make to the plan, potentially some matching contributions, and we'll talk about how a correction looks on stuff like this. And so it negatively impacts the participant or employee. The other aspect of missed deferral opportunities is a situation where certain elements of compensation are not permitted to be deferred upon. I think definition of compensation failures are one of the most common and always on the IRS's watch list. And what that means is you have your kind of regular pay, overtime, PTO, and the various different buckets of compensation. And the programming within a payroll system is set up to recognize which of those a 401k deferral should be made on and matched on. And in certain situations, that programming does not work appropriately. So in the case of my example, I think I said regular PTO and overtime. We've seen situations where the 401k, if someone elects to defer 3%, it's calculated on the regular pay, but it's not calculated on PTO or overtime, but the plan document says it should. So obviously in that situation, an employee would be missing out. So a variety of ways that deferrals can go wrong, and it may leave you questioning, like, how do we get this right? But the main thing is to be able to kind of identify different types of issues. So, and with that, I'll turn it over to Patrick for employer contribution failures.
Thanks, Michael. So for the employee contribution failures, like Michael said, it's when there's a failure to withhold the amount from the employee. So you have a unique circumstance there, because when you fail to withhold an amount from an employee, it's not like they're truly losing out because they get the money in cash rather than it going to the 401k plan. And so there's some, like Michael was describing, there's some nuances there. On the employer side, it's very straightforward. I was supposed to get $100. I got $75. Therefore, I missed out on $25. And so whenever we're talking about corrections with anything related to the employer side, it's real simple. The employer either has to give the amount they should have received but did not, or the employer has to take the amount back that they should not have received but did receive. So the first one we have on here is mismatching contributions. In this case, what we see a lot of times is that the plan sponsor failed to calculate matching contributions in accordance with the plan's terms. It might be because they didn't use the right wages. Most common, and I'm sure Katie would support this, is bonuses. Didn't calculate match on bonuses. If they're eligible under the plan, they need to count for match. And if a participant deferred but didn't get a match, employer has to make the match. Other places we see it are when there's just some kind of system issue that prohibits the match to be calculated, even though it should have been. So that's not great. On the 401A-17 limit, we kind of have the opposite. This is definitely one you don't want to mess up, because the 401A-17 limit is that for matching contributions and employer contributions, plans are not allowed to take into account in excess of a certain limit. In 2025, that amounts to $350,000. And so what we're hearing on this one is that you don't want it to happen, because for somebody to be impacted by a 401A-17 limit, they have to have made more than $350,000. Those are the types of people that have sway in an organization, and you don't want to have issues with on their matching contributions. So when you're looking at your plan, whatever the employer contribution is, you should just make sure that compensation in excess of $350,000 is not taken into account. Final one is that contributions across all source types are maxed out at $70,000 in 2025. So if you have very rich employer contributions, you need to make sure that when you add those together with deferrals and match and everything else, it's not in excess of $70,000. So there, for both 401A-17 and the 415 limit, what you have to do is just go back and take those amounts out of the participant accounts. So again, real straightforward on the employer side. If there was an issue or an error and somebody got more than they should have gotten, the plan sponsor is required to take the money back out of their account. And if they did not, sorry, I'm trying to silence all my messages and they just keep popping up. I don't know why. If they don't, then you just have to take the amount back. If they did not get contributions to which they are entitled, you have to give them that money. Michael, I'll turn it back over to you. Sorry about the external noise, trying to get rid of it.
I think Katie's going to jump in with untimely remittances. So just covering the distinction here. So.
Thank you. Thank you. Just broadly, I wanted to touch on the areas that we're seeing and the questions that we get most from our clients. The first one being timely deposit requirements. Those deposits, many times clients say, well, I have till the 15th business day of the following month. That is like the max safe harbor calculation that the DOL allows. Really, they look at can it be reasonably separated from employer assets? If you're showing within 2 to 3 days that you send taxes off for the employees, you're already showing that you can separate out assets. So average, I would say most of our clients are somewhere between 2 to 6 days, and trying to keep that at a lower amount. If you have a smaller plan, like a safe harbor for a small plan, they allow for 7 business days. You just don't want to get to a high amount, because then there's multiple days where your participants aren't getting earnings, and you've proven to the IRS and the DOL that you can submit within a certain amount of days. So they want to see that those deposits are remitted. If we find that, and you find that there are late deposits, If your standard is 3 days and it's been 12 days, those have to be shown as prohibited transactions on your audit. And then on your Form 5500, they also show as late contributions. Along with that, you have excise tax that has to be paid on behalf of the participants. So there's multiple pieces that have to be done once there's a late contribution. The late contribution needs to be remitted as quickly as possible. Earnings have to be calculated on that. Excise tax has to be paid. And now you have a prohibited transaction. For the DOL, when they come in and look, if you have anything that's over that 15th business day of the following month, they're going to make you put that on your Form 5500. I've seen them even do it over $70, $200. People think sometimes that there's a limit or materiality to what should be prohibited. And the DOL is really clear that they want everything on that Form 5500 that's over. And just to go over a little bit of causes that we see during the audit, probably the biggest one would be staff turnover. So, and we can throw in vacations too, because surprisingly, sometimes it's not a person leaving, it's just they're on an extended leave, maternity leave, they're went on a 3-week vacation, and they don't have strong enough controls in the organization to know this person's out and I should be the one doing the remittals. So standard, you submit in 3 days, but you were on vacation for multiple days. The IRS doesn't approve just because someone's on vacation or there's a turnover. They still want you submitting those timely. And so those would be considered late. Another one would be a payroll conversion or a plan conversion. If you switch which plan you're in, and there's a blackout period and you're not remitting, the IRS and DOL, again, they're still looking for you to do that timely. And so the DOL would see that as a late contribution. So those are two of the biggest areas we see. I don't so much see the cash flow issues with our clients. It's not that they don't have the cash, it's just an error or control issue. Michael or Patrick, I don't know if, through your consulting with clients, if there's any other bigger areas that you see that kind of are leading causes for this.
I can jump in. I would say it's definitely kind of that turnover or process management generally. So.
It looks like we have a couple of questions that just come in. So the first is, we typically do about 1 to 2 business days. Sometimes we'll have a one-off of say 5 days. Our auditors don't like that because we are not consistent, but they're well under the 15th business day of the next month rule. Do you think the auditors are being too harsh, or is that a normal concern for auditors?
Sorry. Yes, I do think it is late, just because you've shown that you can do it with 1 or 2 days. Now, would the DOL come in and disqualify your plan or make you put anything in? One way to consider it is when we look at our earnings due on late contributions, normal 1 to 2 business days late, you don't have to put earnings in. After a couple business days, you're supposed to do earnings. So that's something to consider. Not all auditors will make you show late contributions that are, just a couple days late, but it should be a standard that you're showing that they're consistent. When a DOL does an audit or an IRS does an audit because of late contributions, they will go through and look at what your standard is and ask you why you didn't represent these other items as late because they're over your standard days. So it may be that your auditor is looking to make sure that they're giving you the most conservative view so that if someone comes back in your plan later, that they wouldn't find a different answer.
Okay. And I just time check real quick. I know we only have about 10 minutes to go. So, Michael, I'm going to kick one question over to you, and then maybe we can put it into high gear to get to some of these more important slides and go from there. So, Michael, what is the proper correction process for missed deferrals? If an employee record was not showing in the record keeping system as eligible for a period of time and they weren't able to contribute, do you have to make a contribution or just let them contribute going forward?
Yeah, and generally speaking, there would be a contribution, and we think about it from two sides of this. Patrick mentioned the principle on the employer side. So if there was an employer matching contribution that was missed, that would have to be contributed. And then the other side of things is the employee missed deferral. And from that perspective, the general correction approach, and we have some slides on the details of this, the general correction approach is a 50% contribution to correct the missed deferral, 50% of what would have been contributed by the employee. There are some situations where that would be reduced, but the kind of default approach is a 50% contribution.
Okay. Michael, do you want to jump to the next poll question? Just kind of get high gear, like we said.
Yep.
So our second poll question, which of the following best describes the DOL standard for timely 401k contribution deposits? A, within 15 business days of the following month. B, as soon as administratively feasible. C, by the end of the quarter. D, within 30 days of payroll. And we did touch a little bit on this already, that the max safe amount is 15th business day of the following month. But as many of you saw on the previous slides, that may not be the best answer, especially if you're audited or have to opine for why something's late. Okay, we're at about 63%. Just waiting on that last bit. We're at about 75%. Just make sure you get your poll questions in so you get your CPE credit. You do have to have 3 out of the 4. Okay, and we're going to go into so as soon as administratively feasible is the correct answer. So if you had a payroll today, the 15th business day of the following month is many, many days past when you can separate the assets from the employer.
All right. Jumping into correction programs. The main thing that we wanted to leave you all with on correction programs is both the IRS and the DOL have established programs for potential issues. We talked about missed deferrals; those would be falling within the IRS programs. The DOL programs are going to address late remittances. And then we do have on here, there's a DOL program to correct delinquent Form 5500 filings, which I'm sure never happened. But we definitely wanted to call out the availability and happy to discuss the details of those programs. At the highest level, the IRS correction program, the principle behind it is to put the employee and participant in the position that he or she would have been in had the error not occurred. And that can go both directions, but generally making up for anything that had been missed. And then as we think about benefits, this whole presentation is about ensuring compliance. This is an opportunity for the plan sponsor to fix mistakes before you're subject to an audit, before the IRS or DOL, before they find them. And that is a strong push from both agencies. Obviously, government shutdown aside, they strongly appreciate self-correction. So a lot of benefit in making use of these programs. One of the areas, and I touched on it briefly in response to the question, is that missed deferral opportunities. So the employee has missed an opportunity to make deferrals. And the one thing to think about in this case is that the employee did still receive her wages, his or her wages, but wasn't able to contribute them to the plan. So if we were to give that employee make a corrective contribution in the amount of 100%, then they kind of get a windfall in that situation. The 50% is the standard approach, but in certain cases where you're able to correct sooner, you are able to limit that to either 25% or 0% on the employee side. Match is always going to have to still go in. And so these can be extremely valuable if this issue isn't a one-off and it's a systemic or systematic failure and tens of employees or hundreds of employees are impacted. These reduced corrections can be extremely valuable, and still getting the plan qualified and the employee in a better position. The VFCP program is primarily, it's broader than this, but we see it mainly in the context of missed deferral situations. And the one thing that we want to call out is there is a new self-correction component. I think, Katie, in discussing with you, there's sometimes some, I'd say, confusion about how to correct a missed deferral. And sometimes it's just, we made the contribution, we're good now. VFCP was the standard program to do the correction, and that was generally a submission to the DOL, correcting lost earnings. The new self-correction component is a slightly less burdensome approach to this, but you see there's requirements to that. The lost earnings must be less than $1,000, and the correction or the contributions must be within 180 days. Still requires a submission to EBSA, but it's less documentation behind it. And the important
Michael, can I jump in? Sorry, Katie, I know we need to get 2 more poll questions out there. Do we want to jump to the next one? Sorry, I know we're coming up on time and we have these poll questions. Sorry.
Thank you. Yeah, and we can continue to talk a little bit about the VSCP while this is up, but which of the following is a potential consequence of late 401k remittals? A, plan disqualification, B, excise tax penalties, C, fiduciary breach, and D, all of the above. Michael, and when you were talking about the disconnect, many of our clients, when they're figuring out earnings, they're using a VFCP calculator, and the confusion for many when they see that late schedule that goes with the Form 5500 is they think that they have done a VFCP application, but that is an actual application that has to be submitted. It's not just calculating the earnings using their calculator. So I think that is more of where that disconnect falls of our clients understanding what the VSCP actually is. And that poll result, All of the above, and that's correct. There's can be plan disqualification. We've talked about, that's the last resort, but excise tax penalties and fiduciary breach are both there. And the last part is we just wanted to briefly touch on areas that we see that can help to limit or mitigate those errors. Having robust controls, really spending time going through reconciling what's supposed to be submitted. Many payroll providers like ADP, Paycom have a connector where they're pulling all the documentation directly from you. Can there still be errors if things are misclassified? Yes, but at least the timing of it seems to go a lot faster. There are some automating tools out there or reminders so that your transfers go timely. And then just making sure that anytime you're finding an error, you work quickly and swiftly to try and get that resolved. And these are just a few areas for internal controls that you can do individually within your payroll department or within management, of making sure that all the calculations are done timely, that your match is done on the right eligible compensation, that you're monitoring those deposits. Again, if someone goes on vacation, just really making sure that if something's missed, that you do it timely and get the earnings put on. And then anytime you're doing an earnings calc or doing a late contribution, keeping documentation on those late contributions so that if you're going through audit, that you have all the documentation that you need, either for your financial statement auditors or for the DOL. They will go through if you're audited and look at how you've corrected and what you've done. And so you want to have that backup support maintained for them. I will say they are probably 2 or 3 years backwards, so keeping it for multiple years also. I'm going to go to the poll question, and then Michael or Patrick, if you wanted to add anything on areas that you saw after I read the poll question as you're consulting, that would be great. Did you learn something new about Mr. Late contributions during the session? And you can read those ABCD there.
Yeah, Katie, thanks. And just as a quick comment, I saw a comment a question in the chat. What amount is used to determine the 50% if no contribution was elected? It's difficult to assume what an employee would have contributed. Michael, do you want to take that real quick? Obviously, there's guidance there. If you want to describe that, that'd be great.
Yeah, the general approach is you use the ADP for that particular group. So if an NHCE missed a contribution and has no election on file, to your point, you can't just assume. And so the correction program allows for usage of the ADP percentage for that correction.
Katie, I think we're at time, or just about at time, so happy to stick around for questions. Otherwise, thank you to everybody for joining us today. Sorry we had to kind of speed it up there at the end. This is something Michael and I are probably a little too passionate about. We could easily turn this from an hour conversation into about a 4-hour conversation, but everyone would fall asleep then. So with that, thank you, Katie, for having us, and happy to answer any questions.
And I'm not seeing anything new. I did just want to mention, if you haven't already filled out the survey on your screen, to please do that. We use your feedback to craft our future webinars, so it's really helpful for us to get your feedback. If you want a copy of the slide deck, download that. And if you have any questions going forward, please reach out. We're happy to answer your questions. Thanks again for tuning in, and we hope to see you in the future on webinars.